Carl, they say as soon as you start having kids, you've got to think of this. But the way round that you're talking about here, it doesn't apply to everyone.
No. A Section 785 policy, what I was talking about, is also referred to as a pension term assurance. And it's a life insurance that would normally go to the same time as your pension comes. Sometimes people have it already, and they call it a death in service benefit. So if you've got a death in service benefit, really what you have is the thing that I just described. But they're actually not that common. So what people can do is, if you have children, because you can't use this kind of insurance with a mortgage, is you can instead look to using pension allowances and get an insurance that will bring you up to age 65. And as long as you're not overfunding, as long as you qualify to do it, then you'll get your tax relief at whatever rate you're paying. So up to age 30, you can contribute 15% of your income to a pension. From age 30 to 39, it goes up to 20%, and 5% roughly every 10 years. Very few people put that money into a pension, because that's a huge amount of your income. So this is a way of using that tax allowance, instead of paying for it with after-tax income, is effectively to pay for it with before-tax income. Makes it very, very good, very attractive, and it means that you're actually getting something that is far bigger bang for your buck than you would get even if you went out and got the cheapest deal on the internet or something.
What if you've got a private pension that you're funding yourself?
This is ideal for that. You can get one of these put onto it. The real thing here is, you've got to bear in mind, you can do this independent of any pension, as long as you're not going over your funding limits, as long as you don't already have it, and as long as you're not part of a scheme that doesn't allow it. So for instance, some defined benefit schemes, you wouldn't be able to bolt on this kind of thing to it.
You see, people when they buy a house, they will look for mortgage protection, which of course, should anything happen to them during the life of the mortgage, then it's paid and they move on, and their children and their spouses are fine. This, of course, life insurance is separate to this.
Yeah, this type of insurance is different. With mortgage protection, what happens is it starts off high and it goes down over time. And I've actually seen examples where clients of our firm have passed away, and because it goes down and the mortgage didn't come down at the same rate, that there's money left over that hasn't been paid. Now normally the bank writes that off, but people don't realize that actually is how it works. It's stepping down all the time. This type of insurance stays the same for the whole time. It's called a level term assurance. And basically, the whole thing about needing this when you have children as opposed to when you don't is because if you don't have children, death is tragic, but there's really no one at massive financial loss generally except for your spouse. And if they had a house with no mortgage on it, quite often that, plus things like widow allowance, will ensure that they'll be okay. It's when kids come into the equation that you start to worry. It's kind of like a bell chart, that as you're young, you don't need insurance, and then you might buy a house, it goes up. If you have children, it gets really elevated, and it stays there until such time as they move out of the home and become financially independent. They normally would be gone, given the time that people have kids, and given when kids move out, by the time the parents are age 65. So this is a kind of tricky thing to get right, but you can use little loops in the system to get your insurance for much cheaper, use perfectly legal tax allowances for it, and it will do what you need in your life cycle. But a lot of people don't even know about this. That's why I call it the best kept secret.
Your life insurance will go up throughout your life, though, if you get sick, presumably. Because you have to tell the insurance company if anything happens to you, I take it.
Well, your life insurance will go up if you went out and you wanted to get more, which is why ideally what you do is take out €1 million of insurance when you're 21. It doesn't cost that much and you're in great health. But once you take out an insurance, they can't actually come back and retro price you. So if you took out insurance today and you were a non-smoker and you decided in a year, you know what, I've always wanted to smoke cigarettes, I'm going to start now, and you start smoking 40 a day, they can't actually change your price. They only are allowed to underwrite you on the way in. So all of your health issues, anything that may happen after that point, as long as you're covered, can't be held against you. It only is the situation at the time that you take out the insurance.
I suppose that works both ways. What if you're a smoker and you take out life insurance and then you give up a year later? You're not going to get cheaper, though, are you?
You will, because in that instance, it's actually worth your while because of how heavily they rate you, assuming you don't have something else that would stop you from being able to get insurance, like if you were a smoker and diabetic, and that's why you stopped, but you found out about your diabetes after you took out the first one. It's kind of tricky, but basically, with smokers, it's actually worth your while quite often to cancel an insurance or get what's called an alteration and get the non-smoker rates because your price drops down. One of the other ways to get cheap insurance is for smokers is just don't smoke. Now, it's hard to quit, but it absolutely adds to the bottom line, not only in terms of your health, but in terms of the price that you get on your insurance.
What about, let's say, if a sibling of yours develops, let's say, motor neuron disease?
Yeah.
Will your insurance go up? Would you have to tell your insurance company about what's going on with your close relatives, etc.?
Yeah. Of the 20 common questions out there, one of them is about congenital disorders, familial disorders. So they'll quite often say, have you, your mum, dad, any of your brother, sister had any of these conditions before age 60? You've got to answer all of them. Now, they're not going to go out and do like genome tracking on you or something and find out what you're genetically predisposed towards. But for instance, if you had something that was known to travel in families that always goes from parent to son, there's certain types of cancers that always happens with. There are certain other issues where one person having it means that the next generation have a huge likelihood of it. Well, then they are going to do what's called a PMA. They're going to look to get your medical records. They may even look to do a medical with you, and maybe as far as getting blood samples, etc. Now, if that happens, they're going to need to get some evidence to make a decision on. Mm-hmm. It's actually much more common that things that are just about you in general are what's held against you. So, for instance, habits like smoking, things like what kind of occupation you have, your weight. Weight is a huge one because people are getting heavier, and pretty soon obesity is going to be the single biggest killer in the developed world. And that's what we've seen today is people doing the extreme weight loss. Like, they're actually giving themselves a big health kick as well as raising money for charity. I was very proud of all those guys earlier. I thought they were great. So it just goes to show they should look at their life insurance.
Just very quickly, because we are running out of time. How much tax could somebody save?
Well, it depends on how much life cover you have. So if you took out, say, a few $100,000 and it was costing you around €100 a month, and that was €1,200 a year, if you were paying at the top rate of tax, then something like this would be saving you in or around, 40% of that.
Wow.
And that's a huge chunk. So, I mean, you're looking up around close to €500 simply for changing the type of cover that you have. Okay. No change to the cover, no material change to how good it is while it exists. It's absolutely money in the bank.
Okay. Karl, thank you so much. Okay,
right.
Thank you. Section 785. Remember it, folks. Now, don't forget, if you've missed any of the programme, you can catch it online at tv3.ie/3player. That's it for today.